All right. Today is Tuesday, July 23rd, week 3. Recording is on. What we're going to do today briefly is just talk about your last homework assignment and then begin work on the next week's assignment, which is going to be going into the third section of the course, which is on building the valuation model. I'll also let you know that tonight you're going to be needing Excel, and we're going to be doing some Excel work. The good news for you is that we are going to build the enterprise DCF model in class tonight. And your homework for next week is pretty straightforward. If you're able to do everything that we do in class yourself, so this one, you can't do a homework pair on. You have to do this one yourself. Right? Basically, if you're able to do that by end of class tonight and follow along, you've actually completed next week's assignment, right? If not, you have a week to basically do that. So that's what we're going to be spending a good chunk of our time on tonight. So before we do, any questions about anything? All right. Well, let's take a quick look at last week's assignments. All right, so for last week's assignment, there were two, and one of them is the economic statement conversion. At this point, I think what is the easiest thing is I posted here into week 3. Week 2. The conversion solution is online. So at this point, I'd say 75% of you actually were able to do all of the conversions. For the 25% of you that were not, you struggled mostly with your CFI. I would say take a look at the solution and then let me know what questions you have, unless there's any general questions. We'll go ahead and talk about the EIS or the historical tree assignment in the CFI next. But just kind of pointing out that the solution's there. If you have any questions, let me know. In terms of the week 3, basically what you needed to do is using the Starbucks model, create the trees for Walmart and Costco. Really just a copy and paste exercise, and then the models actually kind of automatically create the trees in the CFI. Again, at this point, I made available the solution files, which is basically the Costco and Walmart files put into Starbucks, copied over. So those are there for you to peruse. I will start with Costco. Walmart. Share in Excel. Here is share. All right, so once you copied and pasted the data in, you should have gotten essentially the Costco ROIC tree, which would have looked like this. Again, any issues with copying and pasting it in that anyone wants to address or wants me to address? All right. Well, once you copied and pasted it in, then it was really analyzing the ROIC tree. And the one we were doing was the one on top. So I'll make it a little bit bigger. And start with Costco. So for their ROIC tree, It's actually pretty straightforward. Uh, Costco is fairly consistent, as you'll start to notice as you go through the tree. But in 2018, they started with a 20.4% end of year ROIC. 5 years later, they improved it to 26.5%. Most of the improvement came between 20 and 21. That's 35% 5-year overall change. Driver number one was the tax rate. 2018, the tax rate was 28.4%. By 2022, it fell to 24.6%. So that was one of the reasons why the ROIC improved for Costco. But even if we look at the improvement for taxes, the underlying business, which is the pre-tax ROIC, also got better. All right. They went from a 28.5% ROIC in 2018 to 35% in 2022. And again, most of that improvement seemed to come between 20 and 21. Right. So what changed that caused the improvement? Pre-tax ROIC. Driver number two, operating margin. They're pretty consistent operating margin every year, built 3%. They started at 3.2% in 2018. They finished at 3.4% in 2022. So that did slightly help the pre-tax ROIC, but the real driver of the improvement was the productivity. Invested capital sales went from 11 cents per dollar to essentially 9.8 cents per dollar. So it's a combination of slightly improved margin and slightly improved productivity that gave them the improved pre-tax ROIC. Okay. What changed about the operating margin at Costco to go from 3.2 to 3.4? Well, ironically, their gross margin went down. Gross margin is the difference between price and cost. If I had to guess, and you can see in 21, the gross margin took the biggest hit, 14.1 to 13.8, and then 13.8 to 13. That was probably some of the impacts of COVID and supply chain issues that a lot of retailers were doing. So the way that they kind of made up for the drop in gross margin of 1 percentage point, is they cut and slashed their SG&A. They were spending 9.8 cents per dollar in 2018, and they're down to 8.7 cents per dollar in 2022. Depreciation was hanging out around a penny. They were at a penny in 2018 and 0.008 in 2022. So really, it was the reason the operating margin improved was primarily because they had a bigger drop in SG&A than the gross margin went down. So just kind of managing costs at Costco. In terms of the productivity, how did they get more productive? Well, they had negative working capital. Again, same thing. If you've ever been to a Costco warehouse, number one, you're paying a membership in advance, $60 or $120. So those prepays are definitely helping their invested capital, working capital. The other thing that's helping them is you're paying cash. You're paying by credit card as soon as you leave the store. So that the credit card payments come to them, 1 or 2 days after you leave the store. So they don't have like net 30 terms. They're not B2B, they're B2C. So that's typical of many retailers, including Target, who we looked at last week. So working capital went from negative 2.8 cents to negative 2.3 cents. Ironically, that hurt them. They have slightly less negative working capital over the 5 years. Where they really benefit in productivity was store productivity. PP&E to sales went from 13.9 to 12.1. So they're getting more revenue out of their essentially stores. And if anybody's been to a Costco, you kind of notice it almost visually. So that was the big driver of invested capital sales improving. So again, the improvement in PP&E to sales of about 1.8 cents, the improvement of SG&A by about 1.1 cents led to an improvement in operating margin and productivity, which led to an overall pre-tax ROIC improving from 28.5 to 35. And combine that with a lower tax rate is why Costco's ROIC went from 20 to 26.5. So something along those lines would be what I'm going to be looking for when I'm grading the assignment. And I'll pause. Make sense? Questions? Hopefully pretty straightforward. All right, going out of order, I'm going to go to the Walmart ROIC tree. Suppose you can show me the CFI. So let me share that. So again, 5 years, Walmart actually saw their end of year ROIC decline. 2018 was 10%. 5 years later in 2022, it fell to 9.3%. The big decline was in 21 to 22. Again, probably COVID related, but essentially a 5-year decline of about 7%. Walmart was paying 37% in taxes in 2018. By 2022, 33.6%. So despite the high tax rate, that was an improvement, and that should have helped their end of year ROIC. So all of the drop in ROIC at Walmart was pre-tax. So the underlying business worsened from about a 16% ROIC in 2018 to 14% in 2022. And again, a precipitous drop between 21 and 22 from 18 to 14. What was behind the decline in pre-tax ROIC? Well, their operating margin fell. So unlike Costco, was fairly stable the 5 years, Walmart saw its operating margin fall from 4.3% in 2018 to 3.3% in 2022. And their productivity did improve. So, kind of like Costco, they were getting more revenue into the stores, but the operating margin decline was worse. And so invested capital sales went from 26.7 to 23.8. That was an improvement by dropping that 11%. So again, the pre-tax ROIC was down all because of the operating margin decline. Why did the operating margin decline a point? Looking at the income statement, second level drivers, their gross margin, like Costco's, also fell 27.2% in 2018, falling to 25.9% in 2022. Again, the big drop between 21 and 22. Their SG&A was flat, essentially 21 cents per dollar in 18 and 22. And their depreciation stayed right around 2%, 2.1% in 2018, slight drop to 1.8% in 2022. So Walmart's entire drop in their operating margin was gross margin. That's really what hurt them. On the productivity side, where they see the improvement, their working capital has been pretty consistent year over year at about negative 1%. PPD to sales went from 21.7 to 19.5. So that's the store productivity. And intangible to sales, unlike Costco, which didn't have any because they're doing acquisitions, Walmart does have intangibles. They went from 6.1 to 5.3. That was also an improvement in productivity, right? So really for Walmart, it was the intangible to sales going down a penny and the PP to sales going down about 2 cents. So that 3 cent combined is where the invested capital sales improved. And that led to the overall improvement in pre-tax ROIC, along with a slightly lower tax rate, allowed them to take their end of year ROIC from 10 to 9.3. But unfortunately, the margin swamped the boat. Questions about Walmart? Hopefully pretty straightforward.
So it was pretty straightforward, but I had a question about like how e-commerce played a part. Like, is that something where the e-commerce of, because obviously COVID and things of that nature kind of made things e-commerce. They became the second e-commerce company outside of Amazon during that time. So
Yeah.
is that something where we put that on a separate, like a separate tree, or is that not accounted
Well,
for? Or
so I'll say this. It's a great question. So when I work with companies, and unfortunately, that's part of the reason why I was a little bit late. I'm in Hartford, Connecticut today, working with a company called RTX. And I'm in a cast, so I was hobbling down the hall to get to the class as quickly as I could in a hotel, the Marriott here. But the point of the story is not asking for pity. It's basically saying that when I work with a company under NDA, I can get the trees for each of the businesses. And I think it's really, really helpful. But when you're dealing with public data, you really can't build the trees as we're doing them here by division. So they're really more at a corporate level than a divisional level. So breaking out e-commerce versus in-store, I think would be very useful to understand. But we're not going to know enough as outsiders at this level of granularity to be able to do that. But I think you can infer, though, that both companies, having e-commerce presence probably boomed more so during COVID, as did all the e-commerce sites. But at the same time, I also remember lining up during COVID to go to the Costco's and to some degree the Walmarts. So, people, had to eat. They needed basic necessities, and these stores actually flourished during COVID, much more so than some other people. But good point and good question. Other thoughts, questions about these trees?
Professor, I have a quick question. about, so I think I might have messed up your, I think you said end of year ROIC was due almost entirely to pre-tax ROIC. Can you
for
explain?
Walmart. Yeah, this dropped because of pre-tax,
Uh-huh.
because the tax rate going down would have helped them.
Hmm.
So it was the pre-tax going from 16 to 14, and the pre-tax went from 16 to 14 because the margin went from 4 to 3. That's really the story of what's going on at Walmart.
Okay.
Because this would have helped. The invested capital sales went down, and the inverse is happening here. So you're spending less on investment to drive sales, then that's better from an ROIC standpoint.
Okay. Thank you.
Sure. But those are the dots that are important for us to connect. I want to just, like I said, this isn't just up, down, everybody can read some numbers, but I want it to connect to how does it drive ROIC? How does it drive the number above? Because that's what this tree is really about. It's about ROIC drivers and what's causing the ROIC to change over time. And this model can work for anything, right? It doesn't have to be a retailer. As you can see, as we're going to do, our next company today is going to be Nvidia. There'll be a tree for Nvidia. We can look at semiconductors in the same methodology. So it's just a useful way to understand the drivers of ROIC. All right, since I'm on Walmart, let's talk about CFI. Okay. So the other thing you had to do was you had to talk about CFI. Now, I did not give you the 5-year summary, which is what we did in class. So if you're going to start with the 5-year summary, you had to pretty much create the 5-year summary. Now, it's been really easy to do. All you would have had to do is column H here, just write total, and then come down here, equals sum, and just sum up 18 to 22. Once you do that, copy it, paste, 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 paste. Be lazy here and just paste all the way down. And then the only other difference is for CapEx depreciation. Basically, copy the formula. And same thing for reinvestment rate. Now you have the 5 years and you're ready to go. Right. So what's going on with Walmart? Well, again, we start out with free cash flow, right? And over the 5 years, Walmart generated $59 billion, $58.971 billion worth of free cash flow, right? So where did this come from, right? The income statement, the gross cash flow generated 131.6 billion worth of cash over the 5 years. They reinvested 58.4 billion, almost all of it in CapEx, giving them an average reinvestment rate of 44%, which basically meant they had theoretically 56% that they could have paid out. Okay. So they had free cash flow before acquisitions after reinvestment in the business, about 73 billion. They spent 14.2 billion on goodwill premiums, leaving them $58.9 billion worth of free cash flow. And again, looks like the big acquisition occurred in 2018. I don't remember vaguely. You guys probably hopefully looked it up. I think that was Bonobos, I believe, was the big acquisition that year, which was the online e-commerce site, but they made a few others.
Red Flipkart.
Which one?
Flipkart.
Flipkart? Yeah. So it gets back to one of the reasons why Walmart was able to do a little bit better in COVID is they made some e-commerce acquisitions that gave them the e-commerce presence. Ironically, something that, for example, Bed Bath & Beyond did not do. That's why they're out of business. But in any event, the next part is assuming we have free cash flow, the question is, what did they do with it, right? So what happened to the non-operating items? Well, the non-operating items, they basically had a loss of about 9.8 billion, non-operating loss over the 5 years. And they had an increase in non-operating assets, 1.7 billion. So those two together combined took 59 billion worth of free cash flow and left them with 48.4 billion of CFI to be paid out to investors. How did they pay out the 48? On the other side of the statement, they paid out about 6.7 billion in interest. They borrowed $16.5 billion worth of debt. Technically, they didn't need to. Probably, though, for them was a little more of a timing difference because 11 billion of debt was the year they probably did the big acquisition, and 2018, but 2019, they borrowed a bunch of debt they didn't really need. And so again, why? Well, they increased their minority interest in other businesses by about 4.3 billion over the 5 years. They paid out 30.5 billion in dividends, pretty consistent, about 6.1 billion a year, but they also repurchased $35 billion worth of stock. So essentially, they had $66 billion worth of payout to shareholders, dividends and share repurchase, which is really why they needed the $16 billion worth of debt, since they only had 48 billion of CFI. Hopefully pretty straightforward. Right. And then last but not least, we go back and look at Costco. Their CFI. This is screen am I on? That's Walmart. Sorry, computer. Costco CFI, same concept. Totals. Oh, what did I just do? B. B. That's weird. B. Paste. All right, so $14.7 billion worth of free cash flow over the 5 years, pretty consistent with the spike in 2021. 30.2 billion of gross cash flow, 15.5 billion of gross investment, 61% average reinvestment rate. Again, 17.5 billion of CapEx is driving all that reinvestment, pretty much 2 billion saved in working capital. That gave them 14.7 billion before acquisitions, and Costco didn't do any acquisitions. They also, and I forgot to mention this for Walmart, averaged a 212% CapEx depreciation ratio. It went down slightly in 2022 to 155%, but they're still signaling growth in 2023 based on that data. 14.7 billion of free cash flow became 10 billion of CFI. Where did the 5 billion go? Well, they put $3.3 billion into excess cash, and they had an increase in non-operating assets of about 1.8 billion, most of it occurring in 2020. What did they do with the 10 billion of CFI? 600 million of interest. They borrowed about 2.8 billion, $2.9 billion worth of debt, $10 billion worth of dividends, $1.7 billion worth of share repurchase. So again, you're talking about 12 billion of payout, 10 billion of CFI. Again, primarily that's why the $2.8 billion worth of debt was borrowed. All of it pretty much coming in 2020, the big increase. Went through that one a little quicker, but the kind of guys get the idea of what we're talking about here. So there's 4 sections. You got to talk about all 4 sections. You start with the free cash flow. Then it's basically, if positive, where to go, if negative, where to come from. That's your framing for the other sections.
Professor, I had a question.
ahead.
I thought for this assignment, we only needed to find the operating free cash flow. Like, are we going to get docked if we did not do the incomplete CFI?
Yes. You have do, because you can't think of it this way. When you did your conversions, you had to balance. So same thing, you'd have to balance the CFI, which means you have to talk about both sides of the CFI. You can't just do half the CFI.
But the assignment said Let me double check.
Yeah, I'm in agreement.
For the
The assignment
free-
clearly states we're not responsible
Yeah.
for the CFI.
All
It
right,
says for the
now if
free cash
I-
flow, you're not doing a full CFI, just operating.
Sorry, if I screwed up in writing the assignment, then let me check what you're pointing out. So financial statement analysis. Oh, you're right. I did say you don't have to do the full CFI.
Okay, just wanted to
So
double
you are
check.
correct
Thank
for
you.
grading purposes. But nonetheless, when you get to your final projects, you have to do the whole CFI. And so take this as what you'd have to do for the rest of the CFI statement.
Makes sense. Thanks.
But thank you for pointing that out. You were correct. I will not dock anybody for doing only through a free cash flow. But the real goal of the statement is to understand where it goes. So that's why it's helpful to understand the rest of the statement. Other questions? Okay. All right. So what we're going to do next is talk about lecture note 3, and then I'll talk to you about what you're going to need to have ready. So as we move to the third section of the class, which is going to be on valuation, let's share here. In the files folder, under week 4, which should be available, I uploaded this data a little bit earlier tonight. So you're going to need these 3, 4, 5 files. Okay. So give you a few minutes to grab all that data ready to go. And the one you're going to need in particular is this Excel model called Valuation Model Nvidia Start. Okay, that's going to be the beginning of next week's homework assignment. But we'll need the data from the screenshots to fill that out. In addition, we're going to talk about lecture note 3, which is under files, lecture notes, lecture 3. So I'm going to start there. All right. So when we go through valuation, we have to understand that a company is worth the sum of its future cash flows. So we're going to be forecasting those free cash flows. But part of the reason why we did the historical analysis is we do look at a baseline. Okay, so we do start with analyzing the historical performance to understand the baseline and the current situation. Then we're going to forecast the future. When we forecast the future, we're going to have 2 periods. We're going to forecast what we'll call short-term performance, period by period, usually year by year, until it becomes less and less meaningful, meaning we have to forecast the entire future of a company, Costco, Walmart, whoever. The problem is, once I get past 10, 15, 20 years, I mean, the forecast becomes less and less meaningful. Got to do it. But the point is, what we typically do is we say, all right, we're going to forecast for a period of time, usually 5 to 10 years. And then we're going to forecast a continuing value or perpetuity period, or some people call it a terminal value period. So we'll have 2 periods. We'll have the short-term year by year, and then we'll have the long-term represented as a continuing value. Okay. We'll apply a cost of capital, discount it to a present value, and then interpret the results. The process itself is actually pretty straightforward. The other thing we're going to do is we're going to forecast using the Modigliani-Miller framework. So if you remember in the last section, when we converted all of the statements, we're going to basically forecast the converted statements. And particularly, we're going to forecast the operating value of the firm. We're going to forecast the non-operating value of the firm. When you do it net present value, you can add them up to become the enterprise value, pay off the debt, and what's left is the equity value divided by share price. So as the book talked about, generally, as I said, 1 to 5 years is probably the most detailed part of the forecast that we will do. And then depending on the model, some people might do a kind of an interim, well, they'll forecast year by year between years 6 and 15, but they'll simplify the forecast in terms of what they're forecasting. So for example, I might not forecast the entire balance sheet. I might just forecast like an invested capital to sales ratio. And then when I get to the long-term period, I do a perpetuity. Most people don't do the intermediate step. They just go year to year and then perpetuity. But you could do this kind of intermediate. I'll forecast year by year, just in less granularity, just because it gets harder and harder to do the further and further you go out. But the idea is a company's worth some of its future cash flows, and we assume that companies don't end. So we do need a long-term forecast for a company. And so essentially, what's going to be important is that, and this was a final exam question last couple of years. How many years do you think you need to forecast before you go to perpetuity? And I asked it as a multiple choice question. I said 3, 5, 7, 10, none of the above. So how many years do you need to forecast before you go to a perpetuity? 3, 5, 7, 10, none of the above. How would you answer that question? What's the right answer?
Depends on your discount rate.
So 3, 5, 7, 10, none of the above.
I would think it would be 10.
Okay, why do you think it's 10, Eleanor?
I would think it'd be 10 because you would want the growth rate to slow down and kind of become constant before you go into perpetuity. It would be my thought process to it.
Alex?
I think building off Eleanor, wouldn't it be, it depends on the company, right? Like if it's a well-established steady state company, you may need less time, but if it's a high growth startup, you may need more time until it becomes steady state. So you can't really answer that question easily without knowing the company you're analyzing.
So Alex, exactly right. Eleanor, you were right in principle, but you get a 0 on the question. So as Alex just said, a company might be mature in far less than 10 years. So you don't need to go 10 years. You could, so for example, I'm in RTX right now. I could probably go 3 years with RTX and then go perpetuity. And it's not going to make much of a difference because they are a fairly stable, steady state, mature company. Whereas a growth company, you might need to go more than 10 years to get them to be mature. And so that's the idea. And the key word there is you want them to be stable when you're in perpetuity. Because it goes back to, we're going to use key value drivers, basically growing perpetuity to represent the long-term future of a company, which means 4 numbers, 3 key ones. ROIC, growth, long-term growth rate, and WACC drive 80% of the value for most companies. And so if I'm going to put 80% of the values based on a formula where 3 things are the most important, then those 3 things can't have wide ranges of what they could be. And that's the problem with putting a growing perpetuity into an early stage company, because you're collapsing the entire future into those 3 numbers. And when there's a lot of uncertainty about what those numbers are going to be, then the valuation can be more challenged. So you want those 3 numbers in perpetuity, ROIC, growth, WACC, to be much more stable. And so that's why we often like to have companies that are more mature when we start a perpetuity period. Now, I'm telling you that for purposes of this class, we're going to do it for 5 years, and year 6 is going to be perpetuity, and that will be arbitrary. Okay, so that's not the right answer in the real world, right? But for purposes of this class, to make it simplistic, we're just going to go out 5 years and then have a perpetuity period. right? And a lot of people do that in the real world, but recognize that that may not be ideal. The other thing you want to deal with is a cyclical company. You don't want to forecast a cyclical company and start the perpetuity at the bottom or the top of the cycle, right? You really want it to be the midpoint of the cycle, right? That would be better for perpetuity, because if you stop and you do the top of the cycle when you're in perpetuity, then you're going to overvalue the firm, right? Same thing. If you stop at the bottom of a cycle, then you're going to undervalue the firm. So that's just another thing you got to be cautious about when you think about the future. Make sense? All right, so in order to do this, we'll need to get the data, which means we'll need historical data. We'll have to build a revenue model, right? And then we'll have to forecast the financial statements. We'll then income statement, balance sheet. We then translate that into ROIC and free cash flow, and then we will discount. Right? But we also have to be careful, because if companies have a bunch of non-operating items, that will affect the model and what to think about that. I'll give you an example. If we were to value Microsoft, right, they made an investment into OpenAI a number of years ago. And I think everybody would say that so far has been a huge success, right? Now, on Microsoft's books, OpenAI is going to be the original book value of the investment they made. It's not the market value of what OpenAI would be worth today, which its value has been increasing exponentially over the last couple of years. And so that would be an example of a non-operating driver that we might have to adjust, right? Because if we just value the original amount invested off the balance sheet, it wouldn't be reflective of the real value of the stake that Microsoft has in OpenAI, because companies, unless you're a bank, are not allowed to adjust and mark to market the values of their investments. Basically, they treat them at book value unless they go down. So you can write things off, but you can't write it up, right? Banks are different, but for non-financial institutions, you can't mark to market. So that's what we mean by a non-operating driver that could affect something. Now, take a company like Costco, which doesn't buy anybody and doesn't invest in joint ventures or anybody else, you don't have to worry about it, right? For a tech company, though, that might actually adjust its value. So that's another thing to think about when we do valuation. Right? Other issues in forecasting, when you deal with forecasting the income statement, which we're going to do in just a few minutes, ideally, you want to tie the driver of the income statement item to the driver of the balance sheet item when you create your ratios to forecast. So for example, cost of goods sold as a percentage of revenue makes sense. But when I value inventory, as an example, I'm going to probably want to tie inventory ideally to cost of goods sold, because that's what's going to show up in the P&L when I expense it, as opposed to tying it to revenue. Now, we're going to take some shortcuts here in class today for reasons that I'll tell you later, but that tends to be ideal. So you got to think about the driver of what's driving each item and make your forecast appropriately. But visually, what you're going to do is you're going to have an explicit forecast period, year by year cash flows, right? Present valued. And then you're going to have a continuing value period, which represents the long term. And we're going to add those two periods together, right? And the continuing value is going to be driven by perpetuity. Now, one of the last things I want you to understand is here's the difference in the McKinsey approach versus a traditional textbook approach. Okay, because when they do perpetuity, continuing value, it's cash flow divided by R minus G. That's just math for perpetuity, right? Problem is when you use cash flow divided by R minus G, one of the assumptions is that you'll get an incremental ROIC that equals the historical ROIC. So what that tends to do is it distorts the directionality of the perpetuity, because it always assumes that whatever you're making now, you're going to make long-term. So for example, if you have an ROIC that's very high and you do a traditional perpetuity, you're going to always stay high. It's going to drive your continuing value up. Right? Now, if you don't use a perpetuity and you just do a cash flow divided by WACC, then you're essentially saying the company regresses the mean because they're not going to have any growth. So those approaches, though they're done, are not ideal. And that's why we're going to use key value drivers, which is the formula rearrange perpetuity, for our continuing value period to give us something more representative. And that is this formula. Because ROIC in the continuing key value drivers formula is, another word for it is RONIC. And that means it's the return on the new invested capital, or another way of saying incremental ROIC. Okay. And so that's what the McKinsey-based approach has as a benefit to the traditional based approach when we use the key value driver equation.
What would be the downside to this approach?
Which one? The McKinsey approach?
The key value driver formula.
Well, the downside to all of these approaches is we're literally, and you're going to see this when we do Nvidia, approximately 80% plus or minus 10 is what this continuing value typically represents. So we're representing the vast majority of a company's value in this simplistic equation. And that's why, for me, the metaphor is we're using a blunt instrument, you know, when we really need a scalpel. But that's the point. Like, how do you forecast out 10 years, 20 years, 30 years? So we're simplifying, but the disadvantage is we're simplifying. So it's just a question of what trade-offs are we making when we're simplifying. And so McKinsey's still making a trade-off when they simplify. They just made one incremental improvement, which is they said, okay, when we simplify, problem with the first simplification method that we're all taught, perpetuities, cash flow divided by R minus G, is that just assumes that the incremental ROIC can never change. So their improvement was I can change an incremental ROIC so it's different in the future than it is in the past, and hopefully it's more representative. But that's the other thing. I still have to have something that's representative. And if I don't have something that's representative, then I'm not going to have a good value for the firm, right? And you know, you're going to find this out after the fact. Because that's the other problem with valuations. We're valuing the future. What is Nvidia? What is Costco? What are they going to do in the next 10 years? Today we guess. Eventually we can adjust when we see what they do. But when you're forecasting the future, you're always guessing. And so that's a limitation to any model that you go through. Teddy?
Has most of the industry adopted the McKinsey method, or is the continuing perpetuity still kind of standard?
I would say it's mixed. I'd say more of the sophisticated firms are taking the McKinsey method or a variation thereof, but there's a lot of people who just use the straight stuff out of textbooks.
Gotcha. Thanks.
Yeah. And I'm not saying you're going to get terrible numbers out of the textbook, but as I said, kind of going back to that previous slide, like, you know, if you do the auto industry right now, and I showed you in the first day of class how poorly the auto industry is doing, and you use a regular traditional growing perpetuity on that, you're implicitly saying that in continuing value, the auto industry is not going to improve. Now, there might be some people who believe that that's the case, but you know, that's the one advantage of the McKinsey model. You say, no, I actually do think the auto industry is going to improve in the next decade. And so I can use a different incremental ROIC. I can't do that with a traditional model. And by the way, there's a lot of people who aren't even exposed to what I'm talking to you about. They just took Ross and Westerfield or Braley and Myers, and in those textbooks, it's just a growing perpetuity. And they either did a dividend growth model or something like that, and they're not getting some of the more sophisticated things we're talking about here. Good question. Other questions? By the way, I want to be really clear when I make these comments. It's not that they're wrong. This is just hopefully an improvement. Okay, but I'm going to teach you the improvements. That's what we're going through. All right. So let's get into the nuts and bolts. I need you to open up the data file, Nvidia Start, the model I told you to download. And as I said, this is going to be primarily what we're going to work on in class tonight. What we're going to do for the next 2 hours, with a couple breaks, is, sorry, to close this. But what we're going to do is we're going to create a valuation of Nvidia. Real world, as of today. This data is from today. And so it was July 23rd. And where did I put the file? And it's similar to the file that you were working on with your homework last week as a starting point. So rather than build it completely from scratch, we're going to kind of build it where it's partially built. I think it was like some of the scaffolding's up, but we're going to finish the building in class tonight. And at the end of this class, we're going to have a reusable model. So it'll take us a couple hours to build the first model. It'll take you 10 minutes to do another company. So it is a reusable model. And this reusable model is going to be tied to Bloomberg. So you really won't be able to use it out of the box with any other data source. It's tied to Bloomberg. Now you can modify it to work with something else, but you would have to modify it. And as I go through it, I'll explain what I'm talking about. But the goal here is to create a reusable model. As I said, for this assignment, you can't use a study buddy. You have to build this model yourself. Okay, very, very important. And the reason is because if I just gave you the completed model or somebody else gave you the completed model, it'll act like a black box and you won't know why things do what they do. So the only way you're going to know how things do what they do is if you put it together yourself. So that's why I need for this model, the building of this model for each of you to do and build it. So we're going to build it together. So I'm going to build it. You're going to follow along. And at the end of this class, we're going to have the model done. Right. And that's your assignment to get to where I get. We build it together. So, and this is being recorded. So you go back and look on video if you can't complete this during class time. Right. But then starting next week, you're going to have another assignment where I'm just going to give you the data and you're going to value somebody else using the model that you built. Then you can use your study buddy again. But at least for this model, I want you to all practice building it yourself. Clear? All right. So back to sharing. All right. So the model that I'm giving you is a series of tabs that go from left to right. Right. So let's talk about the tabs. Right. One of the important things is in order to forecast a company, we're going to have to forecast the P&Ls, the income statement and the balance sheets. That's the income and balance sheet tabs right here in the model. Right. These are standardized income statements and balance sheets. So we're not going to value banks. So this won't apply to a financial services firm. Can't do Capital One using this model. Right? Banks are a little bit unique on their P&Ls. Right? But for a manufacturing service firm, industrial firm, this model will apply to just about anyone. And so the idea is we need a standardized financial statement, income statement, and balance sheet. Now, one of the things is that's why I use a common data source like Bloomberg. But one of the things we've found out about Bloomberg using it over the years is Bloomberg actually doesn't have a standardized income statement and balance sheet for companies, right? And that is a challenge. So here's what I've done in this class. This is a standardized income statement and balance sheet, but it's actually driven by real world data. When companies report their financials, they do, Bloomberg picks them all up, puts them in its format. And so what I've done is I've exported from Bloomberg 6 years. And so we're just going to do the arbitrary 6-year model here. 6 years of historical income statement, balance sheet, and cash flow data. That's what's on this first tab called model data. Okay. And so what I will be doing for the companies that you have chosen to value is I'm going to give you 6 years of historical data in this format. Okay. And then what I've done is I've mapped row by row, cell by cell, so it's got to be exact. For example, revenue for each of the last 6 years to the income statement, revenue for the last 6 years. So the standardized statement pulls from the model data tab. So it's kind of like you're a chef putting together a meal. These are all your ingredients. And then this is what you're actually putting together, the income statement, the balance sheet. Okay. So historical data creates the standardized income statement and balance sheet, which then creates the economic statements. The balance sheet is mapped dynamically, so relative references, to a TFI. So this is a converted and balancing TFI based on the standardized balance sheet. This is a converted and balancing TII based on the standardized balance sheet. This is a CFI based on the balancing TIIs and TFIs that balances. This is the economic profit based on end of year data that balances. This is the ROIC tree, which is created dynamically, which a version of this model is what you did for this current homework assignment that we just went over 20 minutes ago. So this is all historical data. So historical raw data creates historical P&L and balance sheet, which creates historical economic statements, which lead to the historical CFI. That's the most important part of what the model is doing. And I'll pause. Make sense? Questions? So this is all history. That's right. This is the word history. Now, what we're going to do is to do evaluation, we're going to forecast. Okay. So in order to forecast, what we're going to do are some best practices. One of the best practices is that when you forecast, you start by forecasting ratios. Okay. So if I got to forecast revenue, I don't put in a number for 2026 revenue. I put in a revenue growth rate. So the ratios will drive the forecast. So basically what we're going to have here is a historical baseline of ratios in the ratios tab. So all of these ratios, back a little bit, are income statement and balance sheet ratios as a percentage of sales. Okay. The one exception is the revenue growth rate, which is a percentage change. But all of these income statement and balance sheet ratios are a percentage of sales. What we're going to do in just a few minutes is we're going to forecast these ratios, and the forecasted ratios will create the forecasted financial statements. Right. And once we have the forecasted financial statements and forecasted cash flows, we'll create the enterprise DCF. And that's kind of where we're going on our journey. Right. The other thing I want you to understand is we're going to apply another best practice is that when we start putting things in to the future, we want to minimize the places that we make changes to the model. Right. So all of the forecasts that we're going to do that we change ourselves are going to be consolidated to 2 tabs. One tab is called ratios, and the other tab is called assumptions. Right. And then as another best practice, I'm going to use a color. I've chosen yellow. You can use whatever color you want, but I need to understand what can I change in my model and what do I want to leave alone, because there's going to be a lot of formulas and a lot of relative references, and I don't want to break my model. So when I reuse the model, I need to know what's an input that I could change. So an input that I can change is going to be in yellow. If it's non-yellow, you shouldn't directly change it because you might break the model. So that's another best practice, right? Have an ability to make sure you know what you can change and know what you can't change. And the things that you change, you don't want scattered all over your model. Because if you're using a reusable model and use Nvidia, and then you reuse it to do Microsoft, then you don't want some hard-coded number stuck around that you left in for Nvidia in your Microsoft model. Because I can tell you that you'll be up late at night looking at your model saying, I don't know what's wrong. I can't figure out what's wrong. And what's wrong is you forgot to change something that was buried into your model that was a carryover from a previous model, right? And that's just a source of frustration. So to minimize that, all of the changes are going to be in 2 tabs, the assumptions tab and the ratios tab.
7:37 p.m.
Okay. And conceptually, my difference, assumptions are universal, which means they apply across all years. So for example, WACC is one WACC. We don't use different WACCs year by year in our model, right? Ratios are year by year changes. Okay, so ratios change year by year assumptions, universal assumptions go in the assumptions tab. But those are the only two tabs that we're going to make about our future of our model. Again, I'll pause. Questions about any of that? Make sense? All right, so now we're going to begin forecasting, in this case, Nvidia, right? But as we do it, I want to show you one more thing. When you have your next week's assignment, I'm going to give you a different company. It won't be Nvidia. How do you update this model for another company?
You change the ratios?
Not yet. First step is you need to change the data. So what I'm going to do, I'm going to share my desktop so it's easier to see, is I'm going to give you another company's data, but in this case, like Costco's data as an example. So here's Costco. And what you're going to do is this data, which I will give you, which is an export from Bloomberg, let's say we want to switch Nvidia to Costco, is the same as this model data tab, first worksheet of the model, the whole valuation model. So your first step, which I've already done for Nvidia, is, and I gave you a file called Nvidia data, which is where this comes from, but I'll give you another file. Sorry, the Zoom menu is getting in the way of my other menu. All right, here we go. So I would go to the Costco data. I would select all of it, upper left-hand corner. I would copy everything. I would come into NVIDIA. I would right-click here on the model data tab and then paste special values. Don't copy paste, paste special values. Because if you copy paste, it'll link to the other spreadsheet and you'll have problems long-term. So the idea here is if I replace exactly row by row, cell by cell, the model data tab, then all the data is now Costco data in the NVIDIA model, right? But what I did is the opposite. I took, essentially what's in the Starbucks model, and I went to the file I gave you, the NVIDIA data, copied it, went here, select, right click, paste special values, and that is how the NVIDIA data came in. And because everything is a relative reference in the other tabs, this would then be the NVIDIA income statement, balance sheet, etc. So that will be step number one. Now you don't have to do step number one this week because I've already done step number one. But next week you'll have to do step number one. Is that pretty straightforward? So let me close out all of these files because I'll make sure I get the right ones open. And I'm going to reshare the start file for NVIDIA, which is where we are. Okay, so step one, make sure you have the most current data for the company you're valuing. And that's a step I will give you from Bloomberg. Once you put the data in, we're ready to start our valuation. Where we're going to start, as somebody briefly said earlier, is on the ratios tab. This is where we're going to start. Now, on the ratios tab right now, shrink it so it's a little bit easier to see. All right, this is 5 years of historical ratios, 2020 through 2024, based on the balance sheet and income statement. So these are the income statement ratios, these are the balance sheet ratios. Now you're going to start copying what I do. Starting in cell H1 of the ratios tab, we're now going to start creating a forecast. Our first year forecast for NVIDIA is going to be 2025 because they've already reported their fiscal 24. So for cell H2 on ratios equals G2 plus 1. We want to use a relative year for years, relative formula for years, because if we hard code a year, same thing, and the company's years change, then we might have our years screwed up. So always relative references. And the first year that we're going to forecast is 2025. So for 2025, H3 equals G3. As a placeholder, just so we all have the same thing, we're going to assume that 2025 is a repeat of 2024. And because that is a cell that could change the growth rate next year, I'm going to make that cell yellow. Now, just to show you how this process is going to play out, I'm then going to go to the income tab, slightly smaller, starting in cell H2, H1, which is my forecast. Equals previous year plus 1 relative year. For 2025 revenue, here's what we're going to do. Equals last year's revenue, so G3 off the income tab, times left paren 1 plus from the ratios, the 2025 revenue growth rate, H3, right paren. So if Nvidia were to grow another 125.9% next year, their revenue would go to 137,595.09 billion. Now, I want to have the same formatting as the previous column. So I'm going to come in here, comma, 1 decimal place. So 137,595.1, assuming that ratio comes true. So the ratio drives the value of the forecast of the income statement. Pause. Questions? All right, I don't want you to do this, but I'll show you how this is going to play out later. Let's say we think Nvidia is going to grow 45%. Change the ratio to 45, revenue 88,336.9. So as we change the ratio, it will change the P&L on the balance sheet. Now, for just so we're all having the same numbers, we're just going to repeat 2024. Okay, so as we get started, 2024 is just the same in 2025, just as a placeholder. The next ratio that we're going to forecast is EBITDA. EBITDA as a percentage of revenue. Again, as a placeholder, H7 off of ratios equals G7. And that is going to be yellow, because that is something that's going to change. And you might say, gee, why did he skip over cost of revenue and operating expenses and gross profit? I'm taking a shortcut. Now, if this were the real world and you were getting paid to do this, you would forecast cost of revenue, which is cost of goods sold, and operating expenses, which is SG&A. And you'd subtract those two to get to your EBITDA, right? Now, the model doesn't care. The model needs the cash flow. And so we're going to directly forecast EBITDA because it's easier than forecasting the other two that lead to the EBITDA. And the EBITDA is the key driver here of cash flow. So that's a shortcut we're taking. So we're not forecasting the other two. Depreciation and amortization equals the previous year. So equals G8. That's also going to be yellow. Depreciation and amortization is a percentage of sales. Operating income, aka EBIT, is solved. Equals EBITDA minus DA, so H7 minus H8, 54.1%, not yellow. Because operating income is a function of the two above. So I don't forecast it separately if I've already forecasted the other two because they're tied together. Now, I'm making a choice in this model to forecast EBITDA and depreciation to create the operating income. We could have forecasted operating income, added back depreciation to solve for EBITDA, but we had to choose an approach, and this is the approach I'm taking. We forecast EBITDA, we get to our operating income. Next, we need a tax rate going forward for Nvidia equals the previous year as a placeholder, and that will be yellow because that will change. If we have our operating income and our tax rate, we know our no pad or no plat. The formula for that is in cell G11. We basically take our operating income and multiply by 1 minus the tax rate. Okay. If you want to be lazy, just take G11, copy it over to H11. But that's not yellow because that no plat as a percentage of sales is based on the two above. And the final number off the P&L that we're going to care about is non-operating gains and losses as a percentage of sales. Again, as a placeholder, equal the previous year and yellow. Those are the critical income statement drivers that we are going to forecast. Questions? All right, take column H, select the whole column, copy it, go to column M, paste. So at this point, what we're doing is we're just going to assume that the next 5 years after this, so we're going to forecast a total of 6 years, repeat 2024. So 2024 ratios just repeat 6 times as a placeholder as we're building the model. I don't think Nvidia is going to keep growing 126% a year. We'll adjust that a little bit later in class, but for now, this is what we're going to use as a placeholder. Once we've gotten to this point, we're then going to go to the income tab and we're going to start finishing the income statements. So in the income tab, 2025, we'll go to EBITDA, which is H8. So to do H8 equals 2025 revenue, which is H3, times ratios, 2025 EBITDA as a percentage of sales, H7. So it's this number. So 77,874.6 million is our forecast for EBITDA, assuming that revenue comes true and that ratio comes true. Depreciation and amortization equals 2025 revenue, H3, times ratios, H8. Operating income, we're going to solve for this, equals EBITDA minus the DA, H8 minus H9, 74,468.8 million. So very quickly, we have just forecasted Nvidia's EBITDA and EBIT for 2025. Are we following so far?
Can you repeat what you did for the depreciation and amortization?
So for depreciation and amortization, we're going to take the ratio, which is 2025 depreciation and amortization as a percentage of sales, ratio is H8, and we're going to multiply it by our 2025 revenue, H3, similar to what we did for EBITDA. That's going to get you the 3509, 34.05, 3405.9, which we would then subtract from EBITDA to get our operating income. Now these, believe it or not, are the most critical parts of free cash flow, but people like to see entire income statements forecasted out. So we're going to finish up forecasting the rest of the income statement. So here's the thing. You're going to quickly realize that because we're dealing with operating free cash flow, everything below EBIT is not going to matter that much because it doesn't really affect free cash flow. But still, we're going to put it in there anyways. Yes, question? Raymond?
Can you quickly click on what is it, H3 to show the formula for revenue again?
It's just last year's revenue, so it's percentage change. last year's revenue plus one plus the percentage change.
Okay, thank you.
All right, so we use a constant WACC. One of the reasons we use a constant WACC is we assume a constant capital structure. If we have a target capital structure that's constant, that means we're not going to muck around with the debt and the equity. So as a placeholder, whatever debt they have, they keep, and whatever interest they pay, they keep paying. So for interest expense in H11 equals the previous year. Has zero impact on the valuation, but nonetheless, we got interest expense. Same thing, interest income equal the previous year. We're going to just say whatever interest income they make, they're going to keep earning. Not going to change anything about the capital structure. Foreign exchange gains and losses, zero. I don't know what's going to happen to the currencies. Neither do you. No one does. It's the future. We're going to assume most companies hedge, and they don't usually get gigantic gains and losses. So therefore, we're going to assume no FX gains and losses in the future. Now, any assumption that we make, you can override. So if you want to put something in there that you think is more realistic, you're always welcome to do it. But what you'll also quickly notice, it won't have any impact on the valuation. Income loss from affiliates equals the previous year. Whatever gains and losses they have, they're going to keep having. And then finally, non-operating gains and losses, we're going to do this as a percentage of sales. So equals 2025 revenue, H3, times ratios, H12. Pre-tax income. You can look at the pluses and minuses over here. Operating income minus interest plus interest income minus FX minus income loss for affiliates minus non-operating gains and losses is pre-tax income. Or if you want to be lazy, I've already put that formula here in cell G16. So copy G16, go to H16, paste that formula. I also recommend that you save this file. It would really suck if you go along and your computer crashes in the middle of everything we're doing and you lost all your work. So save frequently, or if you have OneNote and Microsoft didn't screw that one up too, you can use your OneDrive for autosave with Microsoft as you're going along. But regardless, please keep saving your file. So pre-tax income would be 75.6 billion. Income tax expense equals your pre-tax income, so H16, times ratios, 2025 tax rate, which is H10. So assuming they paid 12% in taxes, they paid 9,073.2 million. Income before extraordinary items equals the pre-tax income, H16, minus the taxes, H17. They would have 66,539.8 million of pre-tax income. Extraordinary loss, zero. By definition, an extraordinary gain or loss should not recur. The whole point of extraordinary. So if you had an extraordinary loss in the past, you shouldn't have one in the future. And we don't know what weird items are going to happen in the future, so we generally don't forecast them. And so therefore zero. Now, if a company says, oh, by the way, we're going to lay off somebody next year, we announce it, and we're going to have a $2 billion restructuring charge, okay, maybe you could forecast that, but generally we don't forecast extraordinary items in the future. Net income before minority interest equals income before extraordinary items minus the extraordinary loss. So H18 minus H19, 66,539.8. Payments to the minority shareholders. These are dividends of the minority shareholders, right? Nvidia doesn't have any, but another company might. So if a company is paying their minority shareholders, they're going to keep paying their minority shareholders at the same rate. We're leaving the capital structure alone. Equals previous year. So H21 equals G21. net income equals H20 minus H21. Net income would be 66,539.8. So even though Nvidia doesn't have minority interest, we're still setting it up that another company might. That's why we're using some relative references here. Now, Richard,
Could you show the formula that you used for income before XO items?
income before extraordinary items. This one,
H18. Okay.
by the way, is a hint. Usually these formulas in column H are the same formulas in column G. So you can always copy and paste over sometimes. If you, or just look at that formula as well.
Got it.
It's 816 minus 817.
Thank you.
And also the pluses and minuses are over here as well on the left. All right, dividends. If we're not mucking around with the capital structure, whatever dividends they're paying, they keep paying. So again, Nvidia doesn't have preferred stock. They're not paying preferred dividends, but another company might. So for cash preferred dividends equal the previous year. So H23 equals G23. Other adjustments to equity, 0. These are accounting adjustments. When FASB changes GAAP or IFRS is changed by whatever the international body is, then companies might have to adjust their financial statements. These are usually paper changes and generally don't affect cash flows. So we're not worried about the other adjustments. Again, if we knew what they were, we could try and put them in, but they really don't affect our valuations. So therefore 0. Net income available to common shareholders. I put the formula into G25. So take that formula, copy it, paste it into H25. So again, it would be the net income minus the other two. Dividends. Yes?
Sorry, I had just noticed with the formula for H25, or I'm sorry, G25, it's G22 plus G23 minus, I know it's not, it doesn't matter.
It does
The total-
matter. And I intentionally skipped over that part and I'm coming back to it in a minute. So I'm glad you're
Okay.
observant and saw that.
Got it.
But for now, just trust me, just copy and paste the formula and I'll tell you why it's that way in a second. Okay. And this is part of her observation. Dividends, common dividends, same thing. Whatever common dividends we're paying, they're going to keep paying at the same rate. So for H26 equals G26. So Nvidia paid 395 million in dividends last year. They're going to pay 395 million in dividends this year. Okay. This is another best practice to be aware of. Notice that the dividends paid is negative 395. It's not positive 395, it's negative 395. That's because Bloomberg always reports dividends as a negative number. It's a choice in their database and they never change it. Because going back to the 1980s, dividends have always been a negative number. And if one day they switched to a positive number, it would F up so many models on Wall Street that there would be a rebellion. So they can't change their database. But regardless, they report dividends as a negative number. They report operating expenses as a positive number. They report depreciation as a positive number. So on the P&L, expenses are positive numbers. On the statement of cash flow, dividends are negative numbers. Whatever reason they chose to do it, it's what they did. So we just need to be aware of, when you're building this model, what's coming from your data source. Because let's say you switched away from Bloomberg and you switched to another data source where they had dividends as a positive number, and that's going to break this model that we're building, because our model assumes the dividends coming in as a negative number. So knowing that it's going to come as a negative number, to get our change in retained earnings, okay, which is income minus dividends, I would normally take my net income and I'd subtract my dividends. However, because dividends is coming into it as a negative number, that would be a double negative, and it would effectively add the dividends, which would be wrong. So the formula for change in retained earnings in this model equals net income to common shareholders plus the negative dividend, 66,148, 144.8. I also know that cash preferred dividends also come in as a negative number, not a positive number. So the reason why in this cell, in this formula, it's H22 plus H23, it's because I know H23 is coming to me as a negative number. Normally, I would subtract H23, the preferred dividends, but because it's a negative, I don't want to have my double negative problem. And that was the question that you just asked me. Does that make sense now?
Yes, thank you.
Sure. So the important thing is, did everybody get to 66,144.8? Okay. Take column H, select the whole thing, copy it, go to column M, paste it. You now have forecasted income statements through 2030. I know it's some crazy numbers because the growth rate, we'll adjust that later, but you should have now P&Ls going through 2030. And they keep growing 100% a year, they're going to get to $8 trillion worth of revenue. It's probably not going to grow that much. AI is not that big, but regardless, we'll adjust those to be more realistic later. But these are the numbers you got to have as a placeholder now. Then go to your TII. Take column G, copy it. Go to column M, paste it. We now have balancing TIIs going through 2030. And starting in H1, these are now forecast rather than historical. So very quickly, last 30 minutes, we have created 6 years worth of forecasted income statements for Nvidia and 6 years worth of forecasted TII that balance for Nvidia, assuming those ratios come true. Questions? And just make sure you have the same number I do. You got to have that 3.879 trillion number in cell M17 on your TII in the final year.
I'm sorry. Can you show how what you just did with the TII one more time? I think you just copied it.
So once you take your income statement, copy it through 2030. So we now have income statements through 2030. We then go to TII, take column last year, the history, G, copy that, go to column M, paste. And that gets you your forecasted TIIs. Any other questions for right now? All right, so this is a good point for a break. When we come back, we're going to pick up here and go to start working on the balance sheets. So we're going to forecast the balance sheet, which after we do that, will give us the TFI, which will then give us the CFI, and then we're going to do a DCF valuation. Okay, so that's where we're heading next, right? But before we get there, 10-minute break. It's 8:06. Let's start back at 8:16. I'm going to pause the video as well, and I'll see everybody on the other side. All right, recording restarted. Welcome back from the break. Questions about anything we've done so far?
Could you just repeat how you got H20 and H22
Let me share my screen again.
on the income statement?
Income H. So for H20, it's income before extraordinary items, H18 minus the tax impact, H19, extraordinary loss net of tax. And then H22 is H20 minus H21. Income before minority interest minus the minority interest equals net income. Other questions? All right, so our next step is to forecast the balance sheet. Got the income statement and TII. Now we need the balance sheet and the TFI. So you're gonna go back to ratios. All of these ratios, these 11 balance sheet ratios, are a percentage of sales. There's 11. 10 of them. These 10 balance sheet ratios are all a percentage of revenue. Okay. Now, I told you at the beginning of class, we're in the lecture note, and if you're in the book, that's not ideal. Usually you want to tie the balance sheet ratio to the income statement driver. So for example, inventory shouldn't be a percentage of revenue. Inventory should be a percentage of cost of goods sold, right? I'm choosing to do it this way. Everything is a percentage of revenue for two reasons. One, I will tell you now, one I will come back to later. But the reason now is for simplicity, okay? Because the idea is when revenue grows, then the balance sheet grows and just makes our lives a lot easier, okay? So here's how we're gonna handle this. Accounts and notes receivables, a percentage of sales last year, column G, 16.4%. Again, as a placeholder for H14 equals the previous year. We're going to make that yellow. And since all of these are going to be equal to the previous year, repeated 6 more times, we're going to start with H14. We're going to copy that. We're going to select a range all the way down to M23. And we're going to paste that. So what that's going to have the effect of doing is just having everything just be equaling the previous year, whatever we had in 2024 for the next 6 years. Again, as placeholders for those balance sheet ratios. Right? We did not do row 24, which is invested capital sales, which is going to be a formula. That formula, which is in G24, copy it, go to M24 and paste in that formula. Now, right now, we don't have a forecast because we're missing a balance sheet. But what this last row is invested capital to sales. And specifically, where this comes from is the ROIC tree. It's this. So that part of the ROIC tree are these historical ratios. And what we're going to do is we're basically going to forecast the invested capital sales, and we're going to use it as a sanity check when we build our model. All right, so now that we have the balance sheet ratios, we're going to take these ratios and we're going to start creating our forecasted balance sheets. So we're going to go to the balance tab, starting in H1. This is going to be a forecast. Equals previous year plus 1. 2025. The first number we're going to forecast is accounts and notes receivable. So in 2025, accounts and notes receivable, which is H6 in the balance tab, equals from the income tab, 2025 revenue, H3, times from the ratios tab, 2025 accounts and notes receivables a percentage of revenue, H14. I'm going to take all these numbers and forecast them, format them, comma, 1 decimal place, just to match the previous years. Okay. So we're going to do this process 9 more times. So for unbilled revenue equals from the income tab, 2025 revenue, H4, times ratios, unbilled revenue as a percentage of revenue in 2025, H15. Now it's 0 for Nvidia, but it might be a different number for a different company. Inventory equals income 2025 revenue, H3, times ratios, 2025 inventories as a percentage of revenue, H16. Other current assets equals 2025 revenue, up the income tab, ratios, 2025 other current assets as a percentage of revenue, H17. Long-term investments equals income, 2025 revenue, times ratios, H18. Net fixed assets equals 2025 revenue times ratios, H19. Long-term assets is the next one we're forecasting a ratios for, equals 2025 revenue times ratios, H20. Accounts payable is the next ratio we're going to forecast, equals income, H23, times ratios, H21. Then we're going to forecast other short-term liabilities, equals income, H3, times ratios, H22. Final one is the other long-term liabilities, equals income, H3, times ratios, H23. So those are those 10 ratios as a percentage of sales for 2025 on the balance sheet. Make sense? Questions about any of that? All right.
Professor, can you please reshare the formula for cell H14?
H14, other long-term assets. Should be income H3 times ratios H20. So it's basically long-term assets as a percentage of revenue times 2025 revenue.
Thank you.
Sure. Okay, so these are the balance sheet ratios we're forecasting. Primarily the ones that are driving operating invested capital. But we need a balancing balance sheet. So I'm going to show you how to finish off the balance sheet so that it balances, and more importantly, without a circular reference. Any Excel model with a circular reference is an invalid model. If you turn it in, I won't even attempt to grade it. You'll just get a 0, right? You should never have a model with a circular reference. So I'm going to show you how to forecast without a circular reference. So here's the idea. We're going to finish the liabilities and equity side of the balance sheet first. Okay, we'll start with equity. All right. Since we're leaving the capital structure alone, starting with cell H28, whatever preferred stock they have, they keep, equals the previous year. Whatever minority stakes they have in other businesses, they keep, equal the previous year. So G29 or H29 is G29. Any share capital and APIC as additional paid-in capital stays the same. Company's not going to issue common stock. They're not going to buy back common stock. So equals previous year. So H30 equals G30. Retained earnings, that can change. So the formula for retained earnings in 2025, so cell H31 equals starting retained earnings, so G31 plus from the income tab, 2025 change in retained earnings, which is net income minus dividends, H27. So retained earnings will go up by net income minus dividends. So last year's retained earnings plus the change, which is this number, net income minus dividends that we solve for on the forecasted income statement. So that would get us the equity items of the balance sheet. So now we just sum those 4 items up. We sum total preferred equity plus minority interest all the way down to share capital retained earnings, and we get total equity of 109,122.8. Everybody with me? All right, so let's go ahead and finish up the liabilities. Because we're leaving the capital structure alone, whatever short-term debt they have, they keep. So H20 equals G20. Therefore, current liabilities are the sum of the 3 above, the accounts payable, the short-term borrowings, and the short-term liabilities. So other current liabilities, so equals the sum of H19 to H21. $22,150.5 of current liabilities. Same thing with long-term borrowings. That's long-term debt equals the previous year. H23 equals G23. We're not changing the capital structure. We're leaving the debt alone. Pension liabilities, same thing, equal the previous year. We're not allowing the pension to grow. It's not allowed to going forward by the regulators. So whatever pension liability they have, they keep. And then we sum up for long-term liabilities, the 3 above, which is the sum of long-term borrowings, other long-term liabilities and pensions, so H23 to H25. And that gets us long-term liabilities of 15,317. Saw a hand in there somewhere. Somebody had a question?
Yeah, I was running into a couple issues, and I was curious. I think our years aren't lined up. Is the last reported year 2024? Are
Should
we
correct?
okay? So forecast starting in 2024. We can start with accounts.
25. Because the last report is 2024.
Yeah, forecast year 2025. We can start with accounts payable. The last reported year is 2,995 in accounts payable in the balance sheet. Then the ratio I'm referencing is H21.
They should start with column H, which is the first forecast.
Yeah, so H21 is that 4.9 for accounts payable.
Yep.
And I get 5922.6 for 2025 accounts payable.
So accounts payable. So income H3. Do you have?
Yeah, maybe that's off.
137,595.1.
Oh, I don't. Ratios H3.
Which should be based on the growth rate of 125.9%. So equals G3.
Oh, you kept that. Okay. I was looking at the EEO screenshot.
Not yet. That's later. You're getting ahead of me.
Oh, okay. Okay.
Right now, we're just leaving last year as a placeholder. So we all have the same numbers as we're building it, even though some of these numbers start to look a little insane.
Oh, okay. Yeah, my fault. I will hold off on that.
All right. Other questions? Back to the balance sheet. So we now have our total long-term liabilities. So total liabilities, which is H27 equals current. So H22 plus long-term H26. Total liabilities 67.4. Total liabilities and equity equals total liabilities H27 plus total equity H32. So 146,590.3. That's the forecast for liabilities and equity. Now the next step is actually really critical. We have to have a balancing balance sheet. So I'm going to show you the trick to make sure your balance sheet balances every time. So go to cell H16, which is total assets, equals H33. Now we have a balancing balance sheet. By definition, our assets will always equal our liabilities and equity. That was supposed to be a finance joke. I know no one's laughing. But in any event, so here's the deal. I need to get all of the assets on my balance sheet to add up to that number. In order to do that, one of those items on the asset side is going to be called a plug, which means we're going to solve for it to make sure the assets add up to the 146,590.3. The plug is excess cash. So that means we have to have everything else filled out in the assets so we can plug excess cash. What's left? Operating cash. Operating cash in 2025. We go to our assumptions tab. On the assumptions tab, there's an assumption operating cash is a percentage of revenue. 2%. That means 2% of revenue is operating cash. Notice it's not in a ratio because we're going to always leave it at 2%. We're not going to change it. Now we can change it from 2 to 5% or something like that, or the operating cash levels will always stay the same. They won't change year by year. That's why it's on the assumptions tab. So on the balance sheet, operating cash, H4 equals, I'll go the other way. Assumptions, B3 times income revenue in 2025, H3. So 2% of revenue is 2751.9. Now, this is a cell that we're eventually going to copy 5 more years into the future, and there aren't 5 more columns in the assumptions tab. So I need to make cell B3 an absolute reference, which means I need to edit that cell and put a $sign in front of the B and a $sign in front of the 3, and that's going to tell Excel to always use cell B3, even if I copy and paste. The final one that we have to forecast, that's not a sum, is goodwill. For 2025, goodwill, which is H13, equals G13. Goodwill is no longer amortized. It's only impaired. And if it's not impaired, theoretically, it can stay there forever. And even if it is impaired, it has no impact on cash because it's not tax deductible. Right? So to be honest with you, we don't care about impairing the goodwill. We're going to leave it alone. And we can't predict any future acquisitions and future prices on those acquisitions and future goodwill in those acquisitions. So we're just going to kind of leave goodwill, whatever it is, for the previous year and assume any future acquisitions are just NPV 0. So we now finish up the assets. The last asset is excess cash. We're going to solve for excess cash. That's what's called a plug. So the way we're going to solve for excess cash, cell H5 equals total assets, H16 minus everything else. So H16 minus H4, the operating cash, minus H6, accounts receivable, minus H7, unbilled revenue, minus H8, inventory, minus H9, other current assets, minus H11, long-term investments, minus H12, net fixed assets, minus goodwill, which is H13, minus other long-term assets, which is H14. We hit enter. We get 61,049.6 million of excess cash, and more importantly, no circular reference.
Could you share that formula one more time?
It's basically H16 minus every one of those other assets. Minus H4, H6, minus H7, H8, H9, H11, 12, 13, and 14. And that's what I mean by a plug. So it's basically the excess cash we're solving for, because if you add them all up, you need to get to 146,590.3. So I take everything else out. What's left is the plug. So total current assets, H10, just sum those above. Sum operating cash all the way down to other current assets. So H4 to H9. So we have 105,270,600,000 of other current assets. For other long-term assets, we're gonna sum from H11 all the way through H14. And you don't have to do this, but just to show you, if I take my current assets, add my long-term assets, 146,590.3. So adding everything up equals the liabilities and equity from the other side of the balance sheet balances. Questions about that? Everybody with me?
Could you show H31 again? I got lost down there.
H31, retained earnings. So retained earnings is previous year retained earnings. So G31 plus income H27, which is the change in retained earnings at the bottom of the income tab for the year 2025. So how much do retained earnings go up? Add that to last year's retained earnings. That's your new retained earnings.
Got it. Thank you.
Other questions?
I might have missed this. How did you get total current assets to not be a circular reference?
Because we forecast every single item that was left. We solved for excess cash. Then we added in the current assets. Because if we had put in a number for current assets and then tried to solve for current assets, circular reference. So we basically solve for each one of the items, then we add them all up to equal the current assets. So it's a timing issue of how we solve for current assets. Total current assets is after we get the 6 items above. And then long-term assets, same thing, the 4 items above. They're not part of one. Because that would be double counting. Any other questions? All right, home stretch of the balance sheet. Take column H, select it, copy it. Go to column M, select it, paste it. We now have forecasted balancing balance sheets without circular references going through 2030. Assuming all these ratios come true. Back to and by the way, if you look at invested capital to sales, we need a TFI. So we go to our TFI, we take column G, copy column GF of TFI, go to column M, paste. We now have 6 years of forecasted TFI, that balance. Because it's mapped to that balance sheet. And again, starting in 2025, that going forward is now forecast year. And the reason why I'm putting forecast and history at the top is because later I don't want to confuse what's real and what's a forecast. A lot of columns on my spreadsheet. So those are the 6 years of forecasted TFI from the balance sheet. Now I go to my CFI tab. Take column G, which is the 2024 CFI, since everything's relatively mapped, copy column G, go to column M, paste. We now have 6 years of forecasted CFI, which balance. Very important for our valuation. And then we go to economic profit. Oh, sorry, CFI, same thing. This is forecast, type it in again. 2025 to 2030 forecast. And for economic profit, take column G, copy it, go to column M, paste. We now have 6 years worth of forecasted economic profits that balance. And so if you want to know whether you've matched what I've done so far, go to your CFI tab. Your final CFI should be 621.2. If you have that number in M37, then you've basically recreated what I've done so far. Questions? Thomas?
Professor, I do have one. So I do get the 621 that you're showing right there, but the numbers in between I'm not getting. And even on my
You say
my
percent
end of
621?
year, I am still getting 621.
They should be, yeah. All those numbers should be.
Yeah, I'm still getting 620, but the numbers in between aren't matching for me. So it's probably some reference on my end. Because even the end of year tab is showing reference errors
Okay.
as well.
I would just say you might need to go back and look at the video and see which part.
Yeah.
Mistake with.
Okay. Thank you.
All right. Anybody else?
Yes, can you show us your economic profit tab one more time?
Final number should be 3644,587.8.
Thank you.
Could you show the TF5 for a second, please?
6963 465.8. Here. All right. So what we've done so far, we've taken historical data from Bloomberg in a common format. We've created ratios of the historical data. We forecasted the ratios. Right now, we're just staying the same. Those forecasted ratios created forecasted income statements and balance sheets, which created forecasted economic statements and forecasted cash flows in the CFI. Our next step is to do an enterprise DCF valuation of all of this data. So we're going to go down here to plus and add a new worksheet to Excel. And I like to put it at the end. And we're going to rename this worksheet the DCF valuation. And so we're going to do the enterprise DCF valuation of Nvidia based on the forecast data that we have created. Now, following Modigliani-Miller, the first part of the valuation is the operating cash flows. Operating cash flows are based on free cash flow. So starting in our new valuation tab, cell B1, what are the forecasted free cash flows of the company? In our first year equals CFI, first year forecast, H2, 2025, our forecasted free cash flow for 2025 equals B2 from the CFI tab, 2025 free cash flow, row 14, H14, 45,790.8. For formatting, comma, one decimal place, just to match the rest of the model. So 45,790.8 is our forecasted free cash flow off the CFI for 2025. Going down the rows equals previous year plus 1. We need to transpose that for the next 5 years. So 25 through 2029 free cash flow. So for 2026 free cash flow, cell B3 off the valuation equals CFI I is 2026 free cash flow 14. 27 is CFI J 14. 2028 equals CFI K 14. And 2029 equals CFI L as in Larry 14. Again, I want all these to be decimal place. I know these numbers are absurd, but as placeholders, we're going to finish out this valuation, then we'll just be more realistic. So these are the free cash flows that we are forecasting for each of the next 5 years. Currently. We got to present value these. Okay. So what I'm going to do is I'm going to add in the concept of a discount factor. And free cash flow times discount factor is the present value of the free cash flow. Discount factor. If 1 divided by 1 plus R to the N is the formula for present value, the R is the WACC. Okay. So for discount factor equals 1 divided by left paren 1 plus the R, which is off the assumptions, B4, right paren. So if I were to take that number, and I will just 4 decimal places, make it look a little cleaner, and multiply cash flow times discount factor, that present values it. It's basically the same as saying cash flow divided by 1 plus R to the N equals free cash flow times discount factor 45.790.8, and today's value at that WACC is 4165.84. Since I'm going to copy and paste, what I need to do with the discount factor is I want to take assumptions, put a $sign in front of the B, $sign in front of the 4, absolute reference. Copy C2 down to C6. Except in year 2, it's 1 plus 1 divided by 1 plus R to the N. Year 2, N is shift 6, 2. So 1 plus R squared. At the end of this, shift 6, 3. 1 plus R cubed. 1 plus R to the 4th power. And 1 plus R to the 5th power. So if I take B times C, copy it down, these are the discounted cash flows in present value for each of the next 4 years. Questions about what I just did?
Professor, would there be any issue using a year count in the exponent?
No.
So,
no, and you can, remember, you can use the equals present value function in Excel if you don't want to. I'm just old school. But you need to present value the cash flows at the WACC that's in cell D4. In this case, I'm going to sum them up. So the operating value of Nvidia for first 5 years is the sum of those 5 discounted free cash flows, D2 to D6. 1.4 trillion. But that's the thing, Nvidia is going to keep going. So we are going to use a continuing value or perpetuity